Well, hello everybody, and welcome back to another Pepperstone live event here over on YouTube. Today, we're discussing a really interesting topic, which is, of course, going to be building a winning strategy. And specifically, we'll be looking at momentum-based strategies. So I'm really excited to bring this to you today. And I think, as usual, we'll be going through quite a few key learning experiences. And more importantly, we should all get some value from today's session by the end of it. We'll be going into some live charts, some examples, but we'll begin by putting together some of the reasons or some of the ways that we would construct a momentum strategy or any type of real trading strategy to try to get that replication in. Now, often we talk about it here on YouTube as getting the reps in, and that's a really important concept to being successful. Basically, we want to get around 40 replications of the same trade. And once we get that, we can then build whether we've got our statistical advantages, how many we win, how many we lose, and more importantly, start to tweak it a little bit, take profits, stop losses, and everything else. So really with everything you do, you can't drop it. What we tend to do as humans is we drop things too quickly. So we'll go maybe 3, 4, 5. We win maybe 3 of those 5. Then we start taking a loss, a loss, a loss. And I think statistically somewhere around 10 to 12 is where people will give up. That is where it's like win, loss, win, loss, win, loss. Then they'll move on to the next system. Until we have 40 of the same trade and of the same replication, it's very difficult to really get enough of a data set to be able to tell whether we're successful or not. So today we'll be talking about participating in comprehensive understanding of momentum-based indicators and some of the ones that we would use. We'll be looking to interpret momentum indicators. How do we use them on the charts? How do we gain some advantage? All of those types of things. And of course, we'll be looking at the live charts. If you have questions throughout, feel free to ask them. We will be answering those as well. So how do we build a winning strategy? Well, before we go through that, and a big shout out as well to Roman and many others that are joining us here today, I would like to remind you, if you enjoy this type of content that Pepperstone does, make sure to like it. And also, we've got a quick disclaimer just before we get into the rest of today's video. All right, well, we're back, and that means what we can start by discussing how do we actually build a winning strategy. Well, one of the best things we need to do is we first up need to decide where we are in the world and how are we going to be able to trade. What instrument should we be trading? And more importantly, what time zone should we be trading? So we really need to firstly decide that. The second thing we need to do is we need to start from a strong base. What's going to be one of the core principles that we maybe need every single time? Generally, you'll hear most traders, most professionals out there, they'll say we use between 4 and 7 separated reasons. Well, sometimes there's 1 or 2 that they have to have, or at least they really want to have, and they give greater weighting to those. So we need a strong base. I've got a couple of ideas that I'll be showing you today for this strat. And then, of course, we'll begin by adding confluence indicators as well. So let's begin by which time frame is best for you. Well, this comes down to the instrument that we want to select and where you are in the world. If you're from Australia, you may need to focus on the Asian session or the London session. Reason why is time zones are very difficult for the US session, purely based on daylight savings and where we are geographically in the world. Now, of course, I'm from Australia. I like all the sessions. In particular, I love London and US sessions, so it makes it a little bit difficult, but you can do it if you put your mind to it and you have the right setup alerts. And we'll talk about that later on today as well. So what about London session? Well, if you're a currency trader and you like the idea of trading currency, then you might like the London session the most, especially with commodities. We tend to see a huge uptick in volatility and volume during the London session. And these are specifically good if you want to trade things like the pound, US dollar, euro, US dollar, and of course, any other real currencies that are in the Eurozone. If you're trading the Asian session, you might want to look at gold. You also could specifically look at odd USD, and you could also look at USD yen, New Zealand, these types of ones. And you could get a lot of momentum through those as well during those sessions because, of course, they're the ones trading in that time zone. For the US session, almost anything goes. And it specifically is good for indices. It's really great for commodities as well, and US. And you're looking a lot of the time at the overlap between the sessions as the peak of liquidity. So that's when you really get that big move. So, of course, as a momentum-based trader, we want big moves. And more importantly, we want sustained based moves, moves that go from one equilibrium, as we say, to another equilibrium. So, which trade pairs are best to start with? Here's a couple of examples. And I think all of these would be relatively helpful for most of you out there. Let's now move over to recognizing price trends. How do we actually recognize the beginning of something that's going to be big? When it comes to being a momentum based trader, you again are looking for a zone that is usually broken out, either down or up, and you're looking for that kind of consistent swing based method where you're trying to get into that momentum, whether it be a breakout style trade or the dynamic pullbacks, and you're trying to get into that run and ride it for as long as possible. So, what do we look for first? Well, we need to understand that a trend will generally start with what we call the lightning bolt. This can form a really good base of markets, whether you come out of consolidation or whether you come out of just like generally already in a trend. The lightning bolt is really a series of troughs, peaks, higher troughs, higher peaks, high troughs, etc., etc. It's basically a series of higher highs and higher lows. And on the downside, it's a series of lower lows and lower peaks or lower highs. And that's really all that's happening. We're just going for that lightning bolt concept. Pretty simple in principle, but then how do we apply it to charts? Well, we also need to understand how big banks usually enter these positions. And of course, that's going to be very important as well. So, how does a big bank enter a position, you might ask? Well, they enter it over time. It's not like a big institution will be able to place all of their trades at once. So before a great momentum strategy generally appears, there'll usually be some type of storyline. That storyline will be a distribution or an accumulation, and it will go a little something like this. So of course, like any good system, we need to understand where does it start from and how are we going to replicate it. First up, if markets come down to a key level, then they'll start and building a position. So they come down and someone decides, well, I think it's a pretty good bargain here. This is what we call maybe the premium price. Then as it comes down, it will enter their fair value price. And you can see here, I've just got some examples, though it could happen on any time frame. Then it goes down to an even smaller price down here where it gets cheaper. And all of a sudden you see strong buying. Often this will be shown on the charts as some form of wick. So you'll see wicks hold orders or excitement of the market. I say that a lot. We talk about it a lot here on YouTube. Over on Pepperstone's channel. And it's because it's quite a nice footprint that's left by the markets. And this begins kind of like a process of ups and downs and all arounds, where effectively they're buying some here at premium, a lot at fair value, and a little bit at the cheap price. When the market breaks out in either direction, it can begin what we call a momentum-based trade. Basically, the laws of Wyckoff are present here. We have a huge amount of potential effort in here, and the result of that effort is a large move. And it's what we often call the public participation area. Now, if we understand that this was here and that the zone or the storyline looks like a quality build, when it breaks out, not only can we get involved with our momentum-based system, but we can also say that if the quality of that build or sell looks really strong, then it could lead on to a really nice momentum trade. So you can probably start to see that actually what most traders do as a mistake is they don't look at the left-hand side. They don't look at the storyline in the markets. And we'll do some storyline play a little bit later on when we look at it. So markets can do this type of thing. This is, of course, role reversal where resistances become support. And although that's a swing-based strategy, what in essence we're looking for a lot of the time is the break of the resistance. And often to begin a momentum-based strategy, this type of concept will actually begin it. What I like to do is look at the importance of a zone. And we've got some great live examples that we've seen recently on the charts that will show you the importance of when a breakout happens and it closes above all of these weekly levels and daily levels, that there is a good chance that we'll move to the next level of equilibrium. So the next level of resistance or supply on the next side over here. And that area there will be what you're looking to target. Now, all of this then becomes a potential for us to trade momentum-based strategies. We can go into the smaller time frames. We can have a bias, and that bias will be bullish at that point. And we're looking for breakouts. We're looking for pullbacks. We're looking for hard and fast rules where we can replicate a simple strategy time and time and time again. So role reversal, and more importantly, the resistance breakouts or the breakouts of these key build levels are going to be important. Take example here. This is role reversal at its finest. We've got resistance, 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 resistance. We all know what that is. It's a high of the market. Nothing else. It's that simple. Then all of a sudden the market breaks out. This could begin our momentum-based strategy. It basically is a significant breakout. 1, 2, 3, 4. So we know that was a key level. When the market breaks above that, generally it will do so through some form of news. And you'll find that's consistent throughout pretty much any build of these types of strategies. Usually it'll be some kind of news event and it'll be a liquidity event and it breaks through. Now, why this is so important is we already know 1, 2, 3, 4, tons of times it's found sellers here and they've pushed the market down. But notice the storyline here. The market was very, sally. It went down. Then all of a sudden, 1 candle, 2 candles, 3 candles, a little build, and then it went straight through. That's going to be a change in the market sentiment. Something has happened underneath the hood that means that this market is most likely going to go to the next level of equilibrium. And oftentimes what you'll have to wait for here when it breaks out again, and I'll ask everybody in the chat actually, if you know, what would be the most important thing to see when it comes to a market spiking above this 1, 2, 3, 4? When it goes above, what does it need to do on a higher time frame? Let's say this is a 4-hour. If this was a weekly chart and I saw it up here at the end of the week, do you think I'd be happy about that? What do you think in the chat? Let me know. We'll come back to that in just a few moments. So really some examples of momentum-based strategies come back to what types of indicators could we be using as these markets break these key levels. Remember, we need a good core base. The core base is going to be some type of price action, some type of structure, understanding the lightning bolts, those types of things. Well, really, we are looking for moving averages a lot, and we'll go through that in just a moment. We're looking at Bollinger Band indicators. They can be incredibly good for also recognizing breaks, breakouts, and key levels being broken. We can use volume profiles for take profit levels or momentum. A lot of people underappreciate how good this can be. Remember before we mentioned the idea of equilibrium levels. This is where markets can go to. And then, of course, we also have RSI indicators as well that can be used a lot as a momentum-based tool. So a few people have got comments coming in. And yeah, generally speaking, what you're looking for in this example before is the close. So once the close happens, you've got to remember as a storyline perspective, it's locked in. It's not a wick rejection anymore. It's not the market saying, ha ha, took your money, bad luck for you, any of those types of things. That's not what's happening. Instead, what happens is the market closes and finishes at these levels. That means that it's locked in stone that this actually did happen. Now, on average, a close is going to be much more significant than a wick in terms of going through these levels. And the reason why is because it shows that potentially those larger base positions have won and they're ready to move to the next level of equilibrium, the next zone in the markets. And this dictates a point where you need to get involved in potentially your momentum strategy. And we'll go into the charts very soon and we'll take a look at that along with this particular concept as well. So in my opinion, the best momentum indicator probably by far is going to be moving averages, but there's specific ones that are good. And you might say, well, Tom, why would you like moving averages for momentum? There's better indicators out there, such as potentially VWAPs and other things out there right now. The thing is, it's about being able to say replication and understanding that we're wanting to break certain structures and keep it replicable. Yes, we can replicate other indicators as well, but we do tend to find that the 20 moving average, with no exception, is usually the best, especially in indices and even many, many currencies on things like 4-hour and daily. Really good. And when markets break through these levels, you'll see they often come back and test. And we've got some amazing examples that have just happened over the last week of how good this particular strategy has been recently in this market. We've been in strong trends. We broke out of a key level. We closed above, and that led us on to certain critical points that we'll look at today. So is it a basic method? Absolutely. Is it effective? Yeah, it's pretty effective. So how do we get behind moving averages? Well, let's step back a second and just say what is a moving average for anyone out there? Today's an intermediate class, so I'm going to expect most of us know what it is, and we're all pretty well aware of the moving averages. But we've of course got two types that most people use: the SMA and the EMA. So two types of moving averages. They'll look like this. Now, a lot of people don't know it, but most indicators, things like MACD, things like Bollinger Bands, they're actually based on moving averages themselves. And the way they're calculated is they're calculated over a period. If you have a 10 moving average, it's calculated using the last 10 periods of whatever that time frame is. If you are trading a 1 hour chart, it would be 10 hours worth of back data. And all of that comes in, it's then calculated, divided by 10 basically, and you're given a smooth moving average or a simple moving average. In this case, it's going to be the most basic one. If you want to get a little bit more fancy, you're thinking of scalping or day trading or following a more aggressive trend, then you might want to use the exponential moving average. Now, why would you want to use the exponential moving average? Same example, 10, let's say it's a 1 hour, we're using 10 periods back. You'll notice it puts greater weighting on the most recent price action. So if you get that really strong breakout that just happened, that strong breakout is going to be calculated more into this moving average. Therefore, it's going to be closer behind the current price. So why do we want to see this? Well, of course, there are two ways to begin trends. One of them is our method where we're going to be using price action, which I think is much better. And then a lot of people like to say, well, a trend starts when we're above a moving average, let's say a 50 or a 200, or when the two cross together. This is a common strategy. Almost everybody learns it when you first start, and it's just this common ribbon technique. I always say you have to ask yourself this question: could you code this into a robot? Could you put it into a MetaTrader 4 or 5 algorithm or a Pine script or something? Of course you could. Would it work by itself? No, probably not. I don't think so. Not overall. You'd have to figure out so many ways of being able to cut it out of range bounding markets, because what will happen is the market will start to ribbon and that causes an issue. So of course we need a way of overriding this. Well, actually where moving averages are best has to be with dynamic support and resistance. And this is where the real examples come in just a second. Basically, we have here a market. Remember we talked about the peaks and the troughs. We have a market that's going peak with no extra information on the left, which we would want to have. Then we go down and we have a peak and we have a trough. Then we have another higher peak. Then we have a higher trough and we have a higher peak and we have a higher trough. And you get the point here. Now, with these types of dynamic supports or dynamic resistances, they're actually really good when you recognize the pattern. Remember, we talked about the replication before. I get excited about this stuff even to this day. I've been doing this thing for like 15 years. But the reason why most people don't think so, because of the way I look age-wise, but overall, the thing is with this is I still get excited about this basic method, because I remember when I first realized that actually moving averages were best used as dynamic support and resistance. And I remember, spending, I think, like 10 hours checking out charts, going back through time zones and just looking at them in general, long time ago now. And then I started thinking, okay, if we could stack that with this and this and this, and I started to build the confluence. And it's because it actually does work. If you actually see it replicating, then you can get this kind of consistent approach. Now, if you always do it, there's one, there's two touches. Now, when something has a 1 and a 2, and you'll hear I call it the 1-2 method, effectively it becomes potentially a self-fulfilling prophecy. The third, the fourth, the fifth, the sixth, the seventh, all of these times could continue to act as dynamic support. So is it working to this day? Well, a lot of people say, hey, Tom, it doesn't work, man. Well, yeah, okay, might not work for you, but how do we apply it to the charts? Well, here's an example of the S&P 500 taken literally today. And I just want to show you a couple of things here that have happened. First up, remember we talked about this idea that we had a very strong resistance before, where we had that kind of 1, 2, 3, 4. Well, here's a 1, here's a 2, here's a 3. You could even argue that's a 2, that's a 3, that's a 4, that's a 5, that's a 6 kind of breakout at that point. And then, of course, the market will move on. So here's the breakout on the 6th. It goes higher than any previous one. And you could even argue maybe it's there. Now, if you argue it's on the 5th one, When it breaks out, it comes back and it touches this red line. Now, what I've put on this chart is a Bollinger Band. It's a standard Bollinger Band with a 2 standard deviation. I like Bollinger Bands. I find them to be incredibly good for potential TPs. And more importantly, because the middle of a Bollinger is the 20 moving average, it's a great way of starting to recognize and have a 20 moving average on your chart. So what happens here with the Bollinger? Well, for quite some time, the Bollingers thin off. And this is where momentum strategies often come in. A Bollinger will compress because effectively the moving averages are all in ribbon. They're all sitting there floating. If I put a 50 on this chart, it'd be sitting there. If I put a 30 on this chart, it'd be doing this. If I put a 10 on this chart, it'd be doing nothing. It'd be going up and down, up and down, up and down. You get slaughtered using a standard moving average technique. You just would. Anyone been there like that? Has anyone ever had this before? Free trade analysis says very nice learning session. Appreciate it, man. But has anyone ever had this? Free trade or anybody else that's joining us? Have you been trashed by a market that stayed in a ribbon for a little bit too long? I'll put my hand up. This happened to me many, many times. And I was trying to figure out a way, how can I not get destroyed by something like this? Well, it's a mixture of understanding 3 simple things. First up, a lot of resistance. Okay. It's a critical level. It could be a lot of support as well. That would be a critical level. The market has coiled into this. That is, the Bollinger has stayed compressed and very, very tight. When the market starts to pressure and breaks through, it hits the top of the Bollinger, effectively starting to widen the Bollinger off because momentum is actually starting to increase. You'll see if you put an RSI on here as well, RSI will start to rise and it breaks out. Effectively, it closes above. And remember, the key here is it closes above. When that close happens, you're looking for your replication system. So in this case, the close happens, we'll say there, the market comes down, it hits the 20 moving average. I don't know anything yet. I can assume it's breaking out. That's cool, but maybe I don't have the replication I want just yet. Then it goes on to make a new peak and it comes down to the 20 moving average again. That's a 1 and a 2. Okay, then it makes a new peak. At that point, you can start to say, as long as this market's making a series of higher peaks and higher troughs, when it comes back down to the 20 moving average, the next time, and possibly even the next time, we will continuously buy that trade. And that will allow us to get into the momentum of this position. And you'll find that that's actually quite replicable. And again, you might say, well, it's not replication. It won't happen again. Here's an example of Apple recently. A stock that we all like. We all know it. Most of you probably have owned an Apple product at some point during your life. Maybe you haven't. Some people absolutely hate them. But in this case, we see a 1, a 2, a 3, a breach. And then at that point, again, we may not know. We just say, oh, we're in a breach. Fantastic. The market then takes a peak. It takes a trough. It takes a higher peak. It takes a higher trough. What's that? A 1 and a 2. So yes, okay, these are I've cherry picked them in some ways in terms of I've been out setting them up for today's session. But there are you could do this on a 4-hour chart, a 2-hour chart. You could put the euro, you could put the pound on, and you will see periods of time when this happens. And it may not be the 20 moving average, though that does tend to be incredibly good on the daily charts, but it could be a 30, it could be a 50, it could be a 20, it could be a 10, it could be a 15. But you'll often see a replication of a ribbon. So you can be kind of flexible with the idea that it's hitting something, but you need that 1-2 after it breaks up or it breaks down. And then you start to say, well, how long can we ride this for? Well, technically it can ride for hundreds. I mean, it could happen. I think in general, you'll get kind of like a 7 or an 8 best off run. But as it's increasing, you have a couple of opportunities. The first opportunity is, well, how do I know when the trend ends? Well, generally speaking, the easiest way to do it, and we actually did this in our previous video. So if you want to go back and look at that on Pepperstone's last week, because we do these every week here on Wednesday, make sure to attend 8 p.m. AST. But we actually looked at this particular example and we talked about the fact that it had gone up to a peak, trough, higher peak, tested again, lower peak. And that if it came back down here, would we actually want to trade this? And I ask everybody in this room right now, would you want to trade a peak or trough, a lower peak, and then it comes down? No lower trough just yet. Free Trade Analysis says And Craig says, absolutely, that happens to me all the time. And Free Trade says it also has happened to them as well. So, yeah, look, it's very common. It's not something you need to be sad about or you need to say, well, this sucks. How did this happen to me? It's just that you need to understand that the market only trends for great momentum for a certain amount of time. Let's say on average around 4 to 5 months of the year. So because you know that, you're probably going to need to have another trading strategy. This is just how do we build a momentum trade strategy. But yes, we have a peak, a trough, a lower peak, and it comes down again. That's a turn point. You don't want to take that. It's shown that it hasn't made a new peak. A good little tip for today's session and a good tip for you to trade moving forward. If a market has weakened and forced itself not to make a new higher peak, that could show us that it is weakening, it is no good, and that replication that we've learned to trade is no longer there. So some good examples of great moving averages, the 20, the 50, the 100, the 200. If you were to force me to put two on a chart, I'd put the 20 and the 200 on the chart. And I'd use the 200 for if price was above, I'd say maybe it's in an uptrend, and price below, it's in a downtrend. Often when it breaks through a 200 as well, it starts a pretty aggressive trend. So that can sometimes be a bit of a momentum hit. Bollinger Bands can also be incredibly helpful because when we see a coiling of the market, that is all the moving averages start to coil and the market goes sideways, Bollinger will compress. As you push past the 2 standard deviations and close outside of it, similar to that other example then, which was here, that usually, if that's happening and you're breaking through like a 1, 2, 3, 4 kind of resistance or support, that generally will detail that you're probably about to begin a fairly good run. Now, we also know on this chart that we have something called volume profiles, and I've said that's for take profit levels. Well, what volume profiles are is that we get that trend start, and we usually get it based on a large positional trader coming in, buying or selling a ton. The market coils and sits there, and then all of a sudden breaks out, usually due to news. That's the excuse anyway. And then it goes down or up in a big way. When that happens, we need to say, well, where's the level it's going to next? Half the battle is not actually getting into the trade. You could use a moving average, you could use breakouts, all these types of things we're talking about today, and be quite okay. The entry might not be your problem. The take profit and the stop loss will be your issue. So how do we make the take profit a little bit better? Well, we need to understand again how do traders enter these large positions. Well, they build a position again over a period of time, sometimes a few hours, sometimes a few days, sometimes a few weeks. And what it will do is it'll be kind of like a buy or a sell at a certain zone, like we discussed earlier in today's session. Once we know that, we understand that we need to do something Wyckoff told us to do. He said, we need the ability to judge which side has the greatest pulling power. We need to have the courage to go with that side and recognize where the next level is going to be. And of course, he came up with the laws of Wyckoff. So we had the law of supply and demand. And he said that markets will either have demand outstripping supply, the price will be going up. Demand will be under supply, the price will be going down, basic economics. Or demand equals supply, and we'll basically have a range-bound market. When we're in range-bound, we're getting ready to move to the next level. They're building a position, start to think about the storyline towards the next position. Here's a good example of what it might look like on a chart. We've done this before. A build of a position, it trends up. This is where a momentum-based trading strategy wants to get involved. Now, I don't really like taking the breakout. And you might say, well, why do you not like taking the breakout? It's okay if you've recognized this is a key zone, e.g. the Bollinger's been broken above, you know it's a key level, it's broken out, it's closed above, and you think the risk reward makes sense. The problem with taking the closed structure is often when you take that, where's your stop loss going to have to be? Underneath the structural zone. So you're going to need that market to go up quite a lot. If you make it tighter, maybe underneath the candle. So an example here I'll draw that a lot of people use in momentum strategies is that the market breaks out. They then put a stop loss underneath that candle, and then they go for literally the market keep going. You're going to get stopped a lot. That's going to hurt your confidence. Remember, we talked about the reps, how most people at today's session, they give up after they take a few losses in a row and they usually don't get past maybe 10 or even 15 of the same trade method. That's literally the stats. Most of us have probably given up plenty of times before that as we go along our journey to find the thing that works well for us. Well, the issue is that if you take these really tight stop losses, you're going to start losing a little bit more. Your odds might be winning overall over the 40 reps because you're getting great risk rewards. That is, you're taking great profits for your risk that you're actually putting in the market. Problem is you get too many losses in a row. That will hurt your confidence. You'll make decisions that are bad, and you are going to be your own worst enemy. So is that something we want to do? No. We don't want to do that. So the problem is going to be that we most likely will have to put the stop loss below the low or above the high when it breaks out. The risk reward's not going to be very good. So before we talked about that 1-2, it breaks out, comes back, breaks up, comes back, moving average twice, the 1, the 2, then it rallies. As it comes back in the future, you're basically going to be able to buy those rallies, use smaller time frame analysis with the bigger time frame analysis, whatever that might be, and then buy with tighter stop losses. And that's going to allow you to get a lot better risk reward and, more importantly, be potentially able to get into some of these aggressive trends. Now, you don't have to use that same time zone. Remember, as it breaks out, a lot of these momentum-based trends will come back to a specific moving average, and that will become its most loved moving average as it rallies through. It's your job to find the 1 and the 2. And that's a very basic system. But can you see how we've approached it today from a very different methodology? We've said, well, first up, what time frame are we going to trade? What pairs are we going to need to trade for the breakouts that could happen during that liquidity? If the breakouts do occur, how are we going to replicate that system? We need that replication. So what's a volume profile? I think most of you will be aware of this, but if you want to get a volume profile and you trade with Pepperstone, you can get it through a TradingView account. You will need the Pro edition to get access to the volume profile. It's unfortunately one of those kind of higher cost tools, but it's a very excellent one, and we'll talk about it now. So volume profile is basically a horizontal graph that depicts the volume traded at a specific price over a specified period. What distinguishes this from traditional volume, which is where you see it like this, which often people use with momentum breakouts, is that you will see many trades occurred at each, well, you will generally just see this. Now, the problem is with this horizontal or this vertical is that this might represent 1 day of trade, and it's big. It's big volume. Where to go through? What price? Well, because we can use volume profiles, we can actually see where it happens and what the specific period is. So that's really powerful. It's something that we want to be looking at in these markets, and we certainly want to be paying attention to it. So volume profiles are made up of generally 3 bits of information. The first one is going to be the value area. And we've got a question in here quickly. Spot price says, so your entry is on the 3rd touch of that MA. Yeah, that would be a good way of replicating it, man. So basically, spot price, it would be the 3rd touch that you'd be looking at. And the reason you would do it is just so you could be more consistent. Are there faster ways to get in? Yeah, of course. As it breaks past the 4th, if it comes out of the Bollinger, as we said, out of the ribbon Bollinger up the top, news is pushing it through. We close above on a significant time frame. You might say, okay, this thing's on. We're moving to the next level of equilibrium, which we'll work out using a volume profile in a minute, and you could get into it. That will give you a lot more trades, but you will most likely need bigger stop losses. And when you take losses, it'll hurt a little bit more. So I like the 1, 2, 3, 4, 5 method as a great build, but this is just an example of how you can build a strat. Value area highs, value area lows, POC. So basically we get a value area overall, and 70% of the total volume will be traded in that area. Now, I like the POC. Of course, you're looking for points of control, but value area highs and value area lows can also act as resistance or support lines in the market, and they can make up really good areas for us to take profit. Normal distribution theory states that pretty much 68.26% of data will be held within 1 standard deviation. And in fact, if you trade options as well, it goes to 1 to 2 to 3 standard deviations there as well. And the likelihood of price pushing past that point becomes less and less and less. Therefore, most of the time, it's going to stay within this statistical fact. So do you need to mess with this indicator? Absolutely not. It already comes out of the box pretty much perfect. And it's going to look something like this. So you can see here, I've just overlaid this most recent example of the market breaking out. Now, it is fair to state that this previous entry exit points down have a lot of volume in them. There's a huge high up here to low. So if we look at the left-hand side, where were the biggest trades on the way down? Well, it turns out that with volume profile, we can see this. And I'm using what we call fixed range volume profile here on the chart. This zone is the most traded zone on the way down through this entire area. This is the value area high, and this is the value area low. So as the market comes up to this zone, potentially you could look to maybe scale back some of your momentum-based trading. You could also look at the value area high. And what you're going to do here is you're not going to just use, oh, this is the most traded zone, I'm going to take my trade off. But what if this appeared on this level, a resistance, or this appeared on this level, or the value area high literally did appear directly onto the resistance? Could that dictate an area where you might want to consider taking some profit off the table? Well, in my opinion, yes, it could. And of course, it helps you to build when the market breaks out. You're looking, remember, from one movement of equilibrium to the next movement of equilibrium. And that's what we're really doing on charts. We're saying, okay, momentum strategy's on. This thing was coiling for ages. It was sitting at a key resistance. It's closed above, keyword, closed above on a significant time frame, such as the daily or a weekly here. We believe the momentum trade is on. We see the 1, we see the 2, we trade the 3, we trade the 4, we get out. Okay? And this could be happening and replicating on a 5-minute chart, on a 15-minute chart, on a daily chart, on a 4-hour chart, doesn't really matter. As it breaks out of a key zone, you're looking at the left-hand side to see where potentially there are zones. And if you're not that good at reading resistances or supplies or demands or any of those things, volume profile can also help you to just see where were the trades. I want to know where the big trades were. This is something we can start to see on these charts. So volume profile can be really, really good. Which one do I recommend, or at least I think is best on the charts? Well, I'm going to say generally fixed range is definitely preferred for recognizing more precise zones. And then there's the one that most people, I think, kind of make a mistake with, which is going to be visible range, which is when you put your chart on, whatever you see, it just shows you the most traded level. I like to have a little bit more precision. So I like fixed range. And then you get session volumes, which is, of course, pretty useful for day traders, but maybe not as useful for maybe a larger momentum style trade. It's still good, but what session volumes do, if you've never used it, is they show you all of the trade on the chart. So they show you each previous day. Where was the point of control? Where was the value area high? Where was the value area low? Where was most of the trade had in that particular day of trade? And you can see them all stacking up on top of each other. And this can make it so that you can recognize when markets come back to the key levels and when markets also are breaking out and where they might go to next. So it can help you for that one. And it's not a bad tool. So let's jump into the charts here together and have a look at maybe some of the things we could do. And I've just got the S&P 500 here for an example. And I just want to quickly detail again what happened here and the significance of it. Let's have a look at the weekly. And I just want to bring this up again. Momentum, a lot of momentum trading is recognizing a new trend starting and then getting involved in that and then hoping it's going to be good. Let's think about the storyline. We have a wick, we have a wick, we have a wick. Okay, it's rejecting. And it did, sold off. Then it comes up and it finds a level where it coils. Notice where the wicks are. Every one of these wicks past this point actually shows us that there is some kind of buy the dip demand. Buyers are getting excited. Remember, we talked about excitement before? Effectively, this is a coiling market or an accumulating market. Then all of a sudden, all these wicks are taken out by a close, which just so happens to be a hammer at the same time. Upon this candle, and certainly on this candle, you can pretty much know it's on. The market is breaking out of that level. And at that point, you're going towards the next level of equilibrium, which at least needs to be here or as we already mentioned up here, or even that supply on the left-hand side. So really, this becomes likely, this becomes likely, this becomes likely. There's only 3 areas that's more likely to go to. Now, how it gets there, it's going to be up and down and potentially a bit dodgy, but it could be also replicatable. So again, as it breaks out, moving average, new peak, moving average, every time you get that moving average up until it breaks, you will be placing the trades long. Could be a 15-minute chart, could be a daily chart, could be weekly, monthly, doesn't really matter. It's just that kind of replication that we're looking at. So that becomes quite important. And you'll notice that the 20 moving average is specifically quite good on these breakout strategies. So if we just go over here and we have a look at this chart, we have a zone. It's got 1. It's kind of like a little resistance here, resistance again, and it breaches out. As it breaches out, it goes 1, 2, bounces off it again, 3, bounces off it again, 4, bounces off it again, 5, bounces off it again, fail here, it's over. Okay. So you get a couple of nice trades in there, then you lose. And you will eventually lose with a momentum strategy. You're not going to be able to instantly be like, oh, I'm making money every single time, but it does hold in for a couple of good trades. And that's the key. And you can then zoom in on the small time frame and look for little price action based trends. Maybe you're looking for a little lightning bolt on a 15-minute chart as it hits the daily 220. Once you see the lightning bolt in the direction of trend, you take that trade. Guess where you need to put your stop loss? Below the bolt. You can start to see how we build these strategies and we start to put them into perspective. So I guess at this point, considering we've built it today, we've gone through a 1-2 method, we've gone through using a moving average, we've gone through recognizing key resistances and supports that matter. A good hint would be usually at least seeing kind of 3 touches to the zone to upwards of 5 or even more. And once that kind of level breaks, especially once it closes above on a significant time frame, that could instigate your momentum strategy. Yes, you could take that closure, put the low below the wicks or below that last close, but I like the 1-2 strat after that. It's your job to figure out which moving average has become the self-fulfilling prophecy. And a lot of the time it'll be the 20, sometimes it'll be a 30, a 50, or even a 15. So if you have any questions, feel free to ask them now. And I always do encourage it. And I'll just quickly go through another example while we wait for those to come in. But I hope you've enjoyed today's session and you find some value in it. And if you do, remember to smash that like button and let Pepperstone know, as it does help us, really as well create the content that you might want to see in the future. So that would be good. All right. So yeah, feel free to ask it. Let's have a look here at another example. This is, of course, a market which is kind of building over here a little while ago. And you can see it kind of breaks out and comes down and breaks out and it comes down and breaks out and it comes down. These are all higher peaks. So it gets past and you've got a 1 and a 2 and a 3. And then it comes up again and then it goes on for 1 more. And then it's pretty much over. Do you make money from this type of thing? You certainly can. And even though it only gives you 1 excellent entry here, an okay entry here, and a terrible entry, obviously, at the end, there's still profit to be made from that replication. The key is to recognize the higher peaks and the higher troughs. And I just randomly had a look at that there. Peak Daddy says, thanks, Thomas. I learned a lot. No worries. I appreciate that. And I hope you did learn something today. And yeah, I guess that probably brings us to the end then. If there's any questions, leave other questions in the comments down below. I do check them out. So make sure to ask them. And yeah, we look forward to coming to you again next week with some learning experiences. A lot of them are already scheduled. So make sure to hit those alert buttons. And we'll be joined also by Tyrone next week as well to go through some of this. And there will also be a little bit of these as snippets as well in the future that we'll be cutting together as well. James says here, Boki says, sorry if I mispronounced your name, says, thank you very much for this. And James says, thanks, Tom. Do you do this on the short side? Yeah, it's the same thing on the short side, man. Absolutely the same thing. So if you went over here, it's the exact same thing. There will be a moving average. I don't know which one it is because I'd have to play around with it. But that seems like a pretty consistent downtrend. So when the market breaks here, you can see it's like a 1, 2, probably, 2, 3, 4, 5. There's a lot of trades through here that it constantly is bouncing through. As it breaches out, you're looking for where is that replication pick up to. And there will be one that's replicating here. That's when you go for the 1, the 2, the 3, the 4, the 5, the 6 until it breaks. And it's just, look, again, it's just trying to get those reps in, trying to get something a little bit different. That means that, yes, you have to be patient. Yes, I always say that's a key thing. Patience is big. Unfortunately, it sucks to be patient as a trader. Oh, it's painful, but it is the best way. And usually what you want to do is react to the market, predicting the market, predicting, oh, I think it's going to do this. Thinking is not the best. Instead, you want to say, statistically, it's going to do this enough times for me to make money. Once you can start to say it that way, you'll feel a lot better about it. James says, thanks a lot. Looking forward to Vegas. Yeah, that'll be awesome. We are going to Vegas. If anyone's ever interested in that, you can jump on over to fxevolution.com. We will be in Vegas in only a few weeks. So that'll be fun. And Oren says, see you later. And everybody else says, thanks very much. Okay, excellent. Well, thank you so much, guys, for attending. If you do enjoy this stuff with Pepperstone, you enjoy these learning experiences, smash the like button, subscribe to the Pepperstone channel. It's a great one to subscribe to. There's a lot of macro that comes in here, plus us weekly for this type of stuff and some little snippets. And we'll see you next time. Bye for now.